Hi, everyone. Hope you're doing well today. My name is Whitney Ehret. I work for Burnham Benefits for about the last 4 years, and I am the Director of Voluntary Benefits. Today, I want to talk to you about COVID-19 and how we've seen that impact life insurance. So first and foremost, life insurance, ironically, is not about you. It's about your loved ones, and that's really what we want to talk about today. So not only are we seeing everyone panic buy water, toilet paper, really pasta, going to the store this last weekend for our 4th of July, I couldn't find any pasta anywhere. But we're also seeing a huge uptick in people thinking about their families and their futures and what will happen to their family if something happens to them or if they were to get COVID-19. So we've seen people update their wills, a large increase in that, but also we're seeing people be more interested in and purchase more life insurance. So up 50% actually in some studies. What makes this interesting is that when you purchase life insurance outside of your employer, oftentimes you're required to do full underwriting. Full underwriting can require medical questions. It can require blood tests, doctor's appointment, and more often than not, in the direct market, that is what it requires. Well, what we're seeing right now is employees, people in general just don't want people coming into their homes if they don't have to, and they don't want to go anywhere to have those blood tests done unnecessarily or, for life insurance coverage. So a lot of these online platforms are actually just referring to data and analytics platforms instead of actually making you go through any physical testing. So you're still going to have quite a bit of questions if you go to the direct market. Probably take about 10 minutes just in answering the health question section. But if you do offer these products at the employer level, oftentimes, and especially for the initial rollout, what you're going to get is what we call it guarantee issue in the market, which means absolutely no medical questions at all. And then also as an employer offering them, you're giving the employees the convenience of payroll deducted benefits. So as an employer, there's a huge advantage to offering them in the workplace. For employees, huge advantage in purchasing them in the workplace, not to mention you are getting group discounting on the rates when they're offered at the employers. Another change we're seeing in the life insurance market is not only how it's underwritten by data, and by data, I mean, that has been expanded as well. So it's not only an analytics platform that underwriters are looking at, they're looking at your credit scores, they are looking at your social media, they're looking at your any past applications for life insurance that you've actually done before. So those are some pinpoints that they're looking at for the data side. But they're also not issuing policies currently in the direct market for people that are over age 70. And if they are, they're making some modifications to the types of policies or amounts that they can actually purchase. What we're going to talk about today, I'm going to try to keep this a little bit more simple because I could talk about life insurance all day. But there are quite a few different types, and it's important to understand the difference when you're looking at purchasing these options or when you offer these options at the work site. So there two main categories of life insurance are term life, which is something you're going to hear a lot and is the most common type of life insurance. So you might also hear this referred to as group life, oftentimes basic life, that's when it's employer paid, and supplemental life insurance. The other term that you're going to hear a lot in the market is permanent life insurance, and there are two different types under that umbrella as well, whole life and universal life, which I'll discuss more in depth in a future slide. One of these is not better than the other. They just are different, and really financial experts recommend that you look at a combination of both because they really do cover different things, and they are there and in a different time period, a different need. I want to focus first on term life insurance and the different variations you see in the market and what is really available out there. So let's first start at just a specified time period policy. You'll most commonly see a specified time period term, so the name is there. Term life insurance covers you for a period of time. The two main types are you buy a specified period or you're actively at work in the workplace and you have a group term life policy that covers you for that time. So in the direct market, most commonly you're seeing 10-year, 20-year, or 30-year policies. We do have some employer groups that actually offer these types of policies for groups that maybe they have high turnover or they can't meet the participation requirements. Oftentimes when you place a group policy, you're looking at a participation requirement of 20%. Burnham does have robust communications and vendor partnerships that allow to increase participation in these programs and plans, but again, it might not fit every employer, so we do look at each group and make a recommendation based on that. But the specified time period term life insurance essentially is going to cover you for that time period. So if I bought a 10-year policy when I was 20, when I turn 30, it's a guarantee renewable product. And what happens is when I turn 30, I will have the opportunity to renew for another 10 years with no medical questions or underwriting. That's making no changes. If you make changes, you may be subject to underwriting, but now that I'm 30, my rate is going to change. So with these types of plans, you're only locked in for that specified time period. Now, when you look at a group term life, I mentioned basic life before. Basic life is usually a smaller amount of life insurance than your company may pay for. And then there's a supplemental or a group term life policy where you can buy more on top of that. And again, by buying it out of your employer, it's a cheaper rate and you get better underwriting. So as long as you stay under that guarantee issue amount, maybe it's $100,000, you get that coverage guaranteed. If you go over that, then you may be subject to some additional underwriting and you may or may not be approved based on that. What happens here with term life, and is a major differentiator between permanent life, is that these policies don't follow you for life. Again, they are a term policy. So once, for the specified time period, that's the time period you get coverage for, 10, 20, 30 years, that's it. If you don't keep extending that policy or paying your premiums, that policy will lapse and it will cancel, or it reaches that term and it's over. With the group term life, that is for the period of your active employment. Once you leave or you move somewhere else, typically you'll be given the option of conversion. So what conversion standardly means is that you are not going to have the same exact type of policy. It may convert to a permanent life policy. That may change your policy amount. That will definitely change your rate. Any type of conversion is going to change your rate, but it may also change the type of plan that you're enrolled in. Depends on your carrier. Some carriers will also put you in a life insurance pool, which also may change your rate and your product. So that's the main thing with these types of plans. It's either for a really strict period of time or you're at the workplace and it's going to change when you leave. So term, that's really what you're looking at for those. Now, there are two things that are commonly sold on these policies that's completely normal, are age reductions and accidental death and dismemberment coverage. So age reductions really helps the policy be more affordable when employees purchase it. So term life, you're typically buying a higher volume of insurance because you have higher expenses, and once you age up, your policy and premium amounts are also going to age up. So you may have less of a policy amount the older you get because, again, your premium is going to be going up. But your life expenses should also be going down, so you should need less life insurance. Hopefully by 65, 70, you don't have that mortgage payment, your kids are out of school, so your living expenses should be lower. And that's really the whole plan design behind the age reductions. Typical standard or contract provision is going to have 65% at age 50. That's what it will reduce by. And then typically at age 70, it's going to reduce by an additional amount, usually 50%. So 65 and 70 are the ages you have to look at for those age reductions. But again, the policy, if it didn't have that, would be much more expensive at the onset. It makes sense, and that's the kind of theory behind those age reductions in the market. It's not necessarily a bad thing, and that's why we also have the introduction of permanent life insurance, and that's why those complement each other. Accidental death and dismemberment is standardly sold with a term life policy, but not all the time. It could be separate, and really what it does is it doubles your term life insurance if you die due to an accident. So plane crash, car crash, those are the types of accidental deaths it's talking about. Now dismemberment is what it sounds like as well. So those are, you're maybe getting in an accident and you lose fingers or arms or legs, and those will have partial payouts. Very fun stuff, but that's typically some of the provisions you're looking at with term life insurance and some things to just be aware of. Now, I wanted to just switch the focus to permanent life here, some things that they both have in common for whole life and universal life, and some things that make them a little bit different. Again, these are available in the direct market as well as the employer market. For what you're really looking at with permanent life, again, it's permanent. So it is designed really to never change and to always be there and to follow you into those retirement years. So one thing it does have is fixed premium. So unlike term life, you're going to have age bands where it's going to increase as you get older. With permanent life, it's going to be more expensive at the onset because it typically is not going to ever increase on you. Those premiums are always going to be level. This is a policy, usually I would say for employer groups, if you're between 35 and 50, as part of our analysis at Burnham is to take a look at your demographics. And usually we see the most purchasing power in that age range and the most interest in this product. The one thing that this does have, unlike my husband, these policies actually mature. So there is some cash value that you'll have that builds up in these policies that you can borrow against. I wouldn't use that as a selling point of the policy, though. It does take a very long time for cash value to accumulate, but it is there in case it's ever needed. It can also help pay your premiums in a time of need where maybe you're not able to make those premium payments. That's also important because these plans are fully portable. So on the previous slide, I talked about with term life, the conversion options. These are fully portable. So this means if you ever leave your employer for retirement, going somewhere else, any reason really, you own this policy. It's an individual contract between you and the insurance company, and you take it with you. So you not only take the same exact plan, the same exact riders, but you're taking your same rate with you. And remember, that's really important here because these plans don't increase as you age. Now, where are the differences between whole life and universal? Not much. It really has to do with just how the interest rate accumulates for that cash value factor. So with a whole life policy, those are always going to be more expensive than universal life. And the reason for that is it's a fixed interest rate. The market right now is 4%. So it just holds at that interest rate. It doesn't go up, it doesn't go down, and you're always guaranteed that. So it's a nice, safe policy. With universal life, it is a variable interest rate. Your contract is with that carrier and based on their investments. So before COVID, for example, the minimum guaranteed interest rate that they would give you was 3%. And then based on the market and their investments, that would fluctuate, and it has been seen as high as 5.5. So that's an added value over the whole life. Yeah, you could get interest rate a little bit faster at a higher rate than on the whole life policy. Since COVID, actually, we've seen a lot of carriers drop that minimum floor from 3% to 1.5. So things are changing in the insurance market a little bit. But that's just one thing to be cautious about. Universal life is going to be more affordable than whole life, but you have that variable interest rate. So something to look out for when you're in the market for life insurance. One thing I do want to touch on is long-term care. And the reason I'm touching on this is it's a very important subject for many of our employer groups right now, but we're not seeing the sale of this in the standalone market any longer. So whether you're going direct or you're in the employer market, there are actually only 2 carriers left in the market. Genworth, which is now rated a C+ carrier, and many of our clients are looking for another solution. And then we have Transamerica as well in the market. The market is really moving towards selling the long-term care option with the life insurance option, with that permanent life insurance. So essentially what that does is when you sell a permanent life insurance with a long-term care rider, essentially what it does is it accelerates a portion of your life insurance amount for long-term care services. Now the requirement there is you need to have lost 2 activities of daily living, which is your toileting, bathing, dressing, transferring, and I always forget the last one, but there's 5 of them. You need to have lost 2 of those in order to get a long-term care payout. It's very important, and employers, really the only way to get this in the employer base, just a standalone without the life insurance option, is to pay for it for employees, which can be very, very expensive, or to get 50% participation. And honestly, the groups that I've been looking at recently, even though they're willing to do that, they're still getting denied underwriting. So the underwriting market for this is very hard, and what we're seeing again is people going and steering towards that long-term care rider on those permanent life insurance policies. And really, if you think about it that way, those policies do become more expensive, but they're voluntary in the market. Everybody's going to be rated differently. And then what that really does is give them a dual benefit. So that's why that benefit is going to be a little bit more expensive too, because there is going to be a payout on that benefit. It will either be because of death or because of long-term care. So this is a definite need. 52% of people are going to be over 65. And it's a huge need, and it's a huge burden on those families. So when we would look at a demographic analysis at Burnham to look at the placement of these products, we are looking at the age of your individuals and their demographics and their generation. So where are they? Are they that sandwich generation that is feeling this from having older parents and from having younger kids at home that they're paying for college? So these are all things that we put in the analysis, but as you can see, it's ticking up and it's going to be very expensive. And as we're living longer, hopefully, those expenses are going up. So this is one way as an employer that you can offer something that they really can't get on their own anymore. And the underwriting in the direct market is very stringent. So again, I know I've harped on this, but if you go the employer paid, even if it's employer market, even if you're doing voluntary 100% employee paid, you're able to add this long-term care and life insurance guarantee issue. So that is definitely something to think about as an employer in that retraction and attention tool. But these plans are not that easy to manage all the time. And so that's why it's really important for us to talk about the enrollment aspect of this and how we can make this easy for you. So Burnham takes a really strong role with the communication and education. We work with vendor partners, we have internal resources, and we work very closely with your team to set up a strategy that's going to be successful and easy for your administrative team. We understand that the resources aren't there like they always used to be, and we really want to partner in that with you. The product management piece of this obviously would be handled by Burnham, the marketing, the RFP process, and a solid recommendation. All of that can be managed by us, as well as claims assistance, dealing with the plan, the program, questions. We have resources available for that. Payroll administration is one of the biggest challenges and one of the hardest ones to get around, but Burnham does have partners. If this is something that's not able to be administered by your company, but something you have a passion for and something you think your employees would value, then we can have further discussions around how we can make that easier as well. And really, as we think about the workforce, employees are so heavily burdened by everything. Trying to protect their families and their health is number one. By implementing a robust life insurance strategy, making sure that you're at peace of mind and your family would be taken care of is something that would really help the mental needs of those employees at this time. So if you do just have any questions, I know this was quite a bit of information. We're always here to answer your questions and find the best solution you think for your group. So we'll look at your culture, your demographics, and find a solution that you think will work with you. So I hope this wasn't too boring and everyone has a great day and you all stay healthy. Thank you.